Somewhere in a vault underneath Threadneedle Street in London, there is a queue, not a queue of people, a queue of gold. Bars that are supposed to move in 2 to 3 days are taking 4 to 8 weeks to actually change hands, and when a market that has functioned the same way for a century suddenly cannot deliver what it promises on time, that is not a headline. That is a warning shot. For most of this year, the story everyone wanted to tell was simple. Gold to the moon, central banks can't stop buying, the paper market is a sideshow, and the people who've controlled this metal for decades are finally losing their grip. And I understand why that story is so seductive. It has a villain, it has an underdog, and it has a number that keeps going up. But here's what almost nobody is saying out loud right now. In the second week of July, with gold sitting more than $1,000 below where it was trading just 5 months ago, the bullion banks aren't gone. The paper market didn't collapse, and if you've been trading on the assumption that the old rules no longer apply, you may be about to learn a very expensive lesson. So let's actually go through this properly. Not the headline version, the real one. I want to start with what actually happened, because the facts here are wild enough without anyone needing to exaggerate them. Gold spent the back half of last year and the start of this year on one of the most extraordinary runs in its history. It broke $3,000 in the spring, broke $3,500 by September, crossed $4,700 in January, and then on the 29th of January this year, it touched an all-time high above $5,500 an ounce. That is a rally for the history books. Some of you were there for it. Some of you missed it and have been kicking yourselves since. And then something happened that a lot of people conveniently forget to mention when they're telling you gold only goes up. Within days of that peak, the market fell apart. Prices dropped more than 7% almost immediately, and by the start of February, spot gold had collapsed as much as 16% off its high. That is not a pullback, that is a crash by any reasonable definition. The quarter that followed became gold's worst quarter in 13 years. Worst since 2013, the year the last great gold bull run finally broke. Now, why am I opening with the bad news instead of the triumphant headline? Because if you actually want to understand whether bullion banks have lost control of this market, you have to look at both sides of the story, not just the part that makes for a good thumbnail. And the honest picture right now, sitting here in July, is this. Gold is trading around $4,030 an ounce today. That's down more than 5% in the past month alone, even though it's still up over 20% from where it was a year ago. Silver is sitting near $62, well off its own highs. The gold-to-silver ratio has been bouncing between 67 and 73, which tells you both metals have been getting hit, not just one. So here's the real question I want you to sit with for the next 20 minutes. Did something structural actually break in how gold is priced this year? Or did the market simply do what markets always do, overshoot on the way up, and then get violently corrected? Because those are two very different stories, and only one of them is true. Let's talk about what actually did break, because something did, and it's more interesting than the simplified version you've probably heard. Back in late 2024 and into last year, London's physical gold market ran into a genuine problem. The London Bullion Market Association has always promised that spot gold contracts settle in 2 to 3 business days. That's the whole premise of London as the world's physical gold hub. But delivery times stretched out to 4, 6, even 8 weeks. Why? Because gold was flowing out of London vaults into New York at an extraordinary pace, more than 12 million ounces in just 2 months, as traders scrambled to get ahead of potential U.S. tariffs on imported bullion. COMEX warehouse inventories in New York surged 75% in a matter of months. Meanwhile, London's vaults, which on paper held around 279 million ounces, actually had something like 36 million ounces of what's called the float, the gold that's genuinely available for immediate use rather than pledged to central banks, ETFs, or foreign governments sitting in cold storage, against an estimated 380 million ounces of outstanding paper claims on that gold. Do the math on that for a second. When the amount of gold people have a legal claim to vastly exceeds the amount of gold that's actually free to move, and delivery times start stretching from days into months, you are looking at a market where the paper promises and the physical reality have started to diverge. That's not a conspiracy theory. That's the Bank of England's own governor getting grilled by the UK Treasury Committee about exactly this issue and giving what observers described as an evasive set of answers. When your central bank's most senior official can't give lawmakers a straight answer about why gold deliveries are taking 8 times longer than promised, you have a real structural story on your hands. So does that mean bullion banks lost control? Here's where I want to push back on the simplified version. What actually happened is more subtle and frankly more important to understand if you're trying to make money in this market, rather than just feel good about a narrative. What broke was the assumption that London's vaulted gold was as liquid and available as everyone believed. What did not break was the mechanism that keeps COMEX futures and London spot prices tied together. That mechanism is called exchange for physical, and it's the arbitrage plumbing that lets a trader swap a New York futures position for London metal or vice versa. Even during the worst of the delivery backlog, that plumbing kept functioning. Prices in New York and London never actually diverged into two separate markets. They stayed tied together, just under enormous strain. Think of it less like the pipes bursting and more like water pressure spiking to dangerous levels in a system that was never designed to handle this much flow at once. Strained, yes. Broken, no. And here's the part I think is genuinely underappreciated. The bullion banks themselves, the same institutions people love to cast as the villains in this story, were some of the biggest beneficiaries of that squeeze. When physical gold got tight and premiums widened between London and New York, the banks running the exchange for physical trades captured that spread. They didn't lose control of the market during the squeeze. In a lot of ways, they profited from being the only entities with the balance sheet and infrastructure to move gold between two continents at scale during a moment of genuine stress. That's not weakness. That's exactly the kind of role these institutions have played in this market for 100 years, and it's exactly why they're still here. Now let's talk about who actually has been reshaping this market, because there is a real story here. It's just not the one about paper versus physical warfare. It's central banks. China's central bank just filed its data for June, and it's significant. The People's Bank of China added just under 15 tons of gold last month, its largest single monthly purchase since 2023, and it extends Beijing's buying streak to 20 consecutive months, the longest run since at least 2015. And here's the detail that should really get your attention. China made that purchase during the worst quarterly decline in gold prices in 13 years. While retail traders were panic selling and momentum funds were running for the exits, the People's Bank of China looked at gold trading near $4,000, near the low of the entire year, and bought more. Have you noticed that pattern before? Because it's not new. Poland has been aggressively rebuilding its reserves toward a 700-ton target. Uzbekistan added 9 tons in a single recent month. Survey data suggests something like 95% of central banks around the world expect to keep growing their gold reserves this year, with total official sector purchases projected near 850 tons, well above the 400 to 500 ton average that was normal before 2022. Why does that year matter? Because that's when Russian dollar reserves were frozen following the invasion of Ukraine. That single event fundamentally changed how sovereign reserve managers around the world think about holding US dollar assets. If your nation's savings can be frozen by a political decision in Washington, gold sitting in your own vault suddenly looks a lot more attractive than a treasury bond that someone else can freeze with a signature. That is the real structural shift happening in this market. It's not bullion banks losing a fight to paper traders. It's sovereign nations quietly, deliberately diversifying away from dollar dependency 1 ton at a time, regardless of what the price is doing on any given Tuesday. And that's an important distinction because it changes what you should actually expect going forward. This isn't a short squeeze that will resolve itself in a few volatile weeks. Central bank reserve diversification is a decade-long project. It's slow, it's methodical, and it does not care about your entry price or mine. Now let's bring this back to right now, because understanding history is useless if it doesn't help you make sense of what's happening on your screen today. The dominant story in markets this week is not gold, it's oil, and it's the Federal Reserve, and gold is simply the asset caught in the crossfire between the two. Just yesterday, gold fell more than 1% to around $4,050, its lowest level in nearly a week, after the American president declared the interim peace arrangement with Iran effectively over. Oil prices jumped more than 5% on that headline. Iran's Revolutionary Guard has claimed strikes on American military positions in Bahrain and Kuwait in response to earlier American action against Iranian oil exports. This is a live, evolving conflict, and markets are pricing meaningfully higher odds, somewhere around 2/3, that the Federal Reserve ends up hiking rates later this year rather than cutting them, specifically because a spike in oil prices threatens to reignite inflation, just as the Fed thought it had this fight nearly won. Is that not a strange sentence to say out loud? The Fed considering a rate hike in 2026. For years, the entire gold bull case rested on the assumption that rates were heading in one direction, down. Lower rates reduce the opportunity cost of holding an asset like gold that pays you no yield. That was the tailwind. Right now, that tailwind is in serious question. But look at what happened just a few days before that Iran headline, because it shows you how violently this market can swing on a single data point. On the 1st of July, a weak private payrolls report showed American employers added only 98,000 jobs in June, well short of the roughly 118,000 economists expected. The dollar, which had been sitting near a 14-month high, slid on that news. And gold and silver had their best single trading day in weeks. Gold jumped more than 2%. Silver, which has a habit of moving harder than gold in either direction because of its dual role as both a monetary metal and an industrial one, surged nearly 4% in a single session. Then, just days later, the official June jobs report came in even weaker, only 57,000 new jobs, against expectations of around 110,000, with the prior 2 months revised down by a combined 74,000 jobs. The dollar index slid further. Odds of a September rate hike dropped from around 2/3 to roughly a coin flip. So which is it? Is the Fed about to hike because of an oil shock, or cut because the labor market is visibly cracking? Honestly, and I say this as someone who has spent a long time reading these signals, nobody knows for certain right now, and I'd be lying to you if I pretended otherwise. Fed Chair Kevin Warsh has been threading an extremely careful needle in his public comments, acknowledging that inflation risk has eased in recent weeks while simultaneously refusing to commit to any near-term path. Meanwhile, you've got policymakers like Cleveland Fed President Beth Hammack suggesting the labor market still looks consistent with full employment, and even floating the idea that rate hikes might still be needed to get inflation fully under control. That is about as split a committee as you will find, and gold is sitting right in the middle of that uncertainty, whipsawing several percent in either direction depending on which voice gets the loudest headline that day. This is exactly why I don't think it's accurate or honest to tell you bullion banks have been defeated and gold's rise is now some kind of unstoppable one-way freight train. The market you're looking at right now is nervous, it's reactive, and it is being pushed around hard by short-term rate expectations in a way that looks a lot more like the traditional playbook than some new gold order that's replaced it. Would you buy gold at this level, knowing all of that? I think the honest answer depends entirely on your time horizon, and that's worth sitting with for a second, rather than rushing past it. If you're trying to trade the next 2 or 3 weeks based on Fed headlines and oil shocks, I'll be blunt, that is an extremely difficult game right now, and I wouldn't pretend to have an edge calling day-to-day direction in a market this jumpy. But if your horizon is measured in years, not weeks, the structural picture looks meaningfully different, and this is where the analysts I respect most are actually split in a really instructive way. Goldman Sachs cut its year-end target down to $4,900 back in June, explicitly citing the view that the Fed may not cut rates at all this year. JP Morgan, looking at the exact same data, sees gold pushing towards $6,000 by year-end and possibly beyond $6,300 next year. That is an $1,100 gap between two of the most sophisticated research desks on Wall Street, looking at identical information. When professionals with access to the same data disagree by that much, it should tell you something important. Nobody has this figured out with certainty, and anyone promising you they do is selling you something. What both of those banks agree on, interestingly, is the underlying floor. Central bank buying doesn't stop just because Goldman is bearish for the next 6 months. Structural de-dollarization doesn't reverse because of one hot jobs report. That's the piece of this story that I think deserves far more attention than another round of bullion banks are finished headlines. Let's talk about silver for a moment, because I think it's actually the more interesting metal in this entire conversation, and it gets a fraction of the coverage gold does. The Silver Institute is projecting a 6th consecutive annual market deficit this year, somewhere near 215 million ounces, which would be the largest deficit on record, 6 years in a row where the world is consuming more silver than it's mining and recycling combined. That gap has to be filled from somewhere, and it's being filled by drawing down above-ground inventories that took decades to build up. Silver isn't just a monetary hedge the way gold is. It's baked into solar panels, electronics, and a rapidly growing list of industrial applications, which means demand for it doesn't pause just because interest rate expectations shift for a quarter. China's Shanghai exchanges have been absorbing enormous volumes of physical silver, and the premium Chinese buyers are paying over the Western benchmark price has stayed persistently elevated, which is usually a signal that on-the-ground demand in the world's largest industrial economy remains tight, no matter what the futures screen in New York says on any given day. Is this rally sustainable, you might be asking? For silver specifically, the deficit math is hard to argue with. Whether that translates into higher prices next month or next year is a separate question entirely, and one that depends heavily on whether the broader risk environment stays calm enough for industrial demand to keep growing. Let's get into the actual chart for a moment, because I know a lot of you want the technical picture, not just the macro story. Gold has been carving out a descending pattern since March, capped by a trend line that's rejected every rally attempt so far this year. The immediate resistance levels to watch sit around $4,220 and then $4,370 above that. Break through both of those with conviction and you start to make a real case that the correction is over. On the downside, the 2026 low sits close to 4,020, and if that gives way, the next real support zones sit meaningfully lower. Silver's chart tells a slightly different story. It's sitting inside the same falling channel as gold, which makes sense given how tightly correlated these two metals have been, somewhere around 83% over the past 6 months. But underneath that falling channel, there's a double bottom quietly forming. The first real hurdle for silver bulls is around $66.50, a level that's already been rejected once. The number that actually matters is closer to $75. A confirmed weekly close above that zone would break the downtrend entirely and open up a move that some chartists think could run toward $89, which would represent one of the larger technical breakouts silver has seen in years. On the downside, if $59 gives way, you're looking at 52, and then a much deeper zone near 42. I'm not telling you which of those outcomes is going to happen. I'm telling you both are on the table, and that's exactly why this market has felt so uncomfortable to trade in either direction the past few months. Now, here's a curiosity most people watching this space have completely missed. In May, the Prime Minister of India, whose citizens are collectively the largest jewelry buyers of gold on the planet, publicly urged the country to postpone non-essential gold purchases for roughly a year. Think about how unusual that is. This is a culture where gold buying is tied to weddings, festivals, and generational wealth transfer, and the head of government felt it necessary to ask people to pull back, specifically because of concerns about oil prices, pressure on the rupee, and foreign exchange reserves. That single comment likely contributed more to gold's bearish momentum since March than most of the Federal Reserve headlines combined, because it removed a huge, dependable slice of physical demand right at a moment when the market was already digesting the aftershock of January's blow-off top. It's a reminder that this isn't only a story about Washington and London and New York. Demand out of India and China moves this market just as much as anything coming out of the Federal Reserve. Let's zoom out to the historical comparison because I think it puts everything we've discussed into real perspective. Bank of America has pointed out that current equity market speculation is running at its most extreme level since the year 2000, right before the dot-com bubble finally burst. And what happened to gold in the decade that followed that crash? It began a bull run that eventually delivered something like a 659% gain over 10 years. I'm not saying history repeats itself on a schedule, it doesn't, but the mechanism is worth understanding. When earnings-driven assets get priced for perfection and then compress from those extremes, capital has to go somewhere, and it very often rotates toward the one major asset class that requires no earnings, no management team, and no quarterly guidance to hold its value. That's the multi-year argument for gold that has nothing to do with this week's payrolls report. I want to come back to something I said earlier because I think it's the single most important idea in this entire conversation. The story that bullion banks have been defeated is emotionally satisfying, but it isn't quite what the evidence supports. What actually happened this year is that a genuinely stressed physical delivery system in London got tested, strained, and ultimately held, while central banks kept adding gold to their reserves regardless of price, quietly and consistently, for reasons that have nothing to do with short-term trading and everything to do with long-term sovereign strategy. Those are two very different stories, and conflating them into one triumphant headline does you a disservice as an investor because it sets you up to expect a straight line higher when what you're actually likely to get is exactly what we've seen all year. Violent, headline-driven volatility layered on top of a slow, patient structural shift that plays out over years, not weeks. If you're someone who wants clear, research-based analysis on gold and silver instead of the kind of noise that treats every 10% swing as either the end of the world or a permanent new paradigm, that's exactly the kind of channel I'm trying to build here. So make sure you're subscribed because we're going to keep tracking every piece of this story as it develops. There's one more piece of psychology worth naming directly because I think it explains why so many retail investors have had such a painful year trading this metal. Retail money tends to pile in near the top, right when the headlines are loudest and the fear of missing out is strongest, which is more or less exactly what happened in the run-up to that January peak above $5,500. Then, when the correction hits and the 16% drawdown shows up in the account balance, that same retail money panics and sells near the bottom, right around the time institutions and central banks are quietly accumulating. That's not a moral judgment on anyone watching this. It's just the pattern that plays out in nearly every commodity cycle in history, and gold this year has been a textbook case of it. The smart money, if you want to call it that, isn't the group timing headlines. It's the group with a strategy that doesn't change based on this week's jobs report. And that's precisely why central bank buying has stayed so remarkably steady through all of this volatility, while retail sentiment has swung from euphoria to despair and back again in a matter of months. Do you think smart money is already positioning itself for the next leg of this story? Based on what the reserve data shows every single month, I'd say the evidence points toward yes, even if the price action hasn't caught up to that positioning yet. So where does that leave us heading into the rest of this year? Watch three things closely. Watch the Fed, because the difference between a hike and a cut this year is genuinely live and genuinely uncertain, and it will move gold more than almost anything else in the short term. Watch central bank purchase data every single month, because that is the slow tectonic force underneath this entire market, and it has not shown a single sign of reversing, regardless of price. And watch the physical delivery data out of London and New York, because if those delivery times start stretching out again the way they did last year, that will tell you far more about real stress in this market than any headline about bullion banks winning or losing. I genuinely want to hear where you land on this. Do you think gold still has real room to run from here, or are we due for a deeper correction before the next leg higher actually begins? Tell me in the comments, because some of the sharpest pushback I get on this channel comes directly from people watching this market as closely as I am. And if this kind of deep, sourced breakdown is useful to you, the simplest way to support the channel is just to hit like and share it with someone who's been asking you whether gold is still worth paying attention to at these levels. Because here's the truth, nobody wants to put in a thumbnail. Gold and silver haven't broken free of the old rules. What's changed is who's playing the long game underneath all that noise, and that game is far from over. I'll be back with the next update the moment something meaningful shifts. Until then, stay sharp out there.